The federal government accused Goldman Sachs today of fraud. The Securities and Exchange Commission filed civil charges against the powerful Wall Street investment banking firm. The SEC alleged Goldman did not disclose it was marketing subprime mortgage securities while at the same time betting against them through a large hedge fund. Investors in those securities lost more than $1 billion when the housing market crashed. In response today, Goldman called the charges completely unfounded. It is the most prominent case brought by the government thus far in response to the financial crisis. Zachary Goldfarb is covering that story for the Washington Post. Zachary, welcome.
Thank you.
In the simplest of terms, what is it exactly that the government has said Goldman Sachs did?
The government has said that Goldman Sachs defrauded its investors by omitting key details about investment products that Goldman was selling them. In essence, the government has said that Goldman allowed a fund that was betting against these products to create the products and then sold the investment to investors without telling them that someone who was betting against them had come up with the idea and formulated a large part of it. So it's an issue of defrauding investors.
And the allegation is that Goldman Sachs created this kind of double bet situation, right? Right,
that's right. Goldman has been accused and criticized for taking a stand against the housing market for itself and on behalf of some clients, while letting other clients invest with Goldman Sachs and bet on the housing market. So it tried to make a profit, allegedly, both ways.
And there's one, they named one vice president of Goldman Sachs as the main perpetrator, alleged perpetrator, correct?
That's right. Fabrice Touré, a Goldman vice president who's now in London, allegedly came up with the idea and knew weeks and months before creating the investment product that it was going to fail, or that the entire housing market was going to start a significant decline. And the SEC has obtained emails showing that or suggesting that. He has not released a statement yet today defending himself, although Goldman has said that the charges are untrue.
And they plan to fight them all the way, right? That's their statement?
That's right, and that's quite unusual. Most banks and entities dealing with the SEC settle on the day that charges are filed. They don't want
the first time you hear about it is when they settle, right?
Right, that's right, because companies don't want to deal with the public relations struggle or the legal costs involved. Goldman, however, has been willing to really go its own in many ways in the financial crisis, and it's been immensely profitable for them to do so. But it's really another, example of Goldman pushing its own sort of approach to dealing with its public relations concerns.
Now, there was a hedge fund that was involved in doing the betting on the downside, right? And it's John Paulson. It's run by John Paulson, a very prominent person in the hedge fund business in Wall Street, correct?
That's right. John Paulson made billions and billions of dollars personally by creating exotic techniques to bet against the housing market when everybody else was betting that it would continue to rise. And Goldman Sachs helped him do that. Now, the allegation is that on behalf of him, they created a security that they then sold to investors who believe the housing market would continue to go up. And he benefited from this, although the SEC has clearly said today he didn't play a role in any kind of fraudulent action. So he's not being charged. He's not facing any allegations of wrongdoing. It's Goldman Sachs that is facing those allegations.
And the word there, of course, is that Paulson saw the collapse coming and went with that bet on his own, and Goldman Sachs just simply bought into that bet, correct? Without telling people they were doing it.
Right. Goldman was paid $15 million to create this sort of exotic financial instrument. It's very complicated that Paulson was able to use to bet against the market. At the same time, they were promoting it as a positive thing to their investors. And so without telling them that Paulson played a role in creating the product. That's the allegation.
All right. Now, why civil charges rather than criminal charges?
Well, a couple of reasons. The SEC, first of all, doesn't have criminal authority. That's the Department of Justice, and we don't know if there's a Justice Department investigation. There may be one. But the second reason, and perhaps more important, is that a civil case has a lower threshold for action than a criminal case, and it's very hard to, beyond a reasonable doubt, prove financial fraud. It happens, of course, but it's very hard to do. And so if you want to bring a case as fast as possible and get financial remedies and other sanctions, you often go the civil route first, and there always can be a criminal case to follow.
So what specifically is the government asking as a penalty against Goldman Sachs?
Well, they're asking for a few things. They're going to seek a financial penalty, a pure penalty, which is supposed to deter further conduct. They're going to seek that Goldman Sachs repay any gains it had. So that could include both the $15 million it was paid in fees, but also perhaps $15 million in fees from Paulson, but also possibly up to $1 billion in investor losses on the fraudulent security. And then there could also be other kinds of gains we don't know about. In addition, there could be a variety of sanctions against Goldman Sachs, limiting its ability to do business in this area if the court agrees with the SEC.
Did this come as a big surprise on Wall Street that the SEC was going to move against Goldman Sachs? Or was this expected?
People were surprised today. There's been a lot of discussion about Goldman Sachs and other big banks. There was a big case with Bank of America recently that was much more, I think, pretty well known in public before it came. People were somewhat surprised by the Goldman Sachs case. I mean, I think people were surprised that there was no settlement in the works either. So I think people are surprised. The SEC is under a new team now, and they're trying to sort of show the world that post-Madoff, they can reform themselves, and they're continuing to do so. But really, the devil will be in the details as the court case unfolds, and it could be actually years and years before there's any kind of resolution, which shows how difficult this is. This is dealing with conduct from early 2007. We're in 2010 now, and if there's a court case, it could be 2011, 2012 before that's resolved. So 4 or 5 years between conduct and resolution, and that shows how difficult it is to prosecute these kinds of cases.
Sure. Okay. Zachary Goldfarb, thank you very much.
Thank you.
And now to the other news of the day. Here's Hari Srinivasan in our newsroom.
The Goldman Sachs news rattled Wall Street after 2 months of steady gains. The Dow Jones Industrial Average lost nearly 126 points to close at 11,018. The Nasdaq fell 34 points to close at 2481. For the week, the Dow gained a fraction of a percent. The Nasdaq rose a little over 1%. Federal bank regulators came under fire today over the largest bank failure in U.S. history. It happened at a Senate hearing on the 2008 collapse of Washington Mutual, commonly known as WAMU. Democratic Chairman Carl Levin of Michigan lashed out at the Office of Thrift Supervision.
OTS was a feeble regulator. Instead of policing the economic assault, OTS was more of a spectator on the sidelines, a watchdog with no bite, noting problems and making recommendations, but not acting to correct the flaws and the failures that it saw. At times, it even acted like a WAMU guard dog.
The head of the office, John Reich, denied he'd been too cozy with WAMU managers, and Sheila Bair, chair of the Federal Deposit Insurance Corporation, said her agency did all it could. Battle lines have hardened on a bill to reform financial regulation. President Obama called again today for reining in derivatives. They include the mortgage-backed securities that triggered the housing market collapse. The president said, quote, "I will veto legislation that does not bring the derivatives market under control."